It is Tuesday, February 24th, 2026. And, usually we start these conversations with a big, uh, like an abstract concept, something philosophical.
Right, a high-level overview.
Exactly. But today we need to get very specific, and we really need to do it fast. Because if you are one of the, 70 million Americans relying on Social Security?
Roughly 70 million, yeah.
Right. So if you're in that group, this specific week, like right now, the end of February, is a bit of a wolf in sheep's clothing.
It really is. I mean, it looks like a standard end-of-the-month wrap-up. You're checking your calendar, maybe planning for the weekend.
Just doing normal budget stuff.
Exactly. But if you look at the banking logistics, and specifically the federal payment schedules we're analyzing today, this week is actually a critical test of what the source material calls cash flow governance.
Cash flow governance. I love that term. But it also sounds like something a CFO at a Fortune 500 company worries about, Not someone just trying to pay the electric bill.
Sure, it sounds corporate, but that's exactly the point of the analytical report we're digging into today. The authors argue that we tend to view Social Security as this steady, clockwork heartbeat.
You get the check, you pay the bills, you move on.
Right. But the logistical data for 2026 paints a very different picture. The report actually describes the system for this year as having hidden rules and optical illusions.
Optical illusions with money. That's never good.
No, it's really not. And it's not malicious on the government's part. It's literally just the calendar. 2026 is an abnormal year calendrically. The way the dates fall is actively working against your natural intuition about money.
And in personal finance, relying on intuition instead of the rigid federal schedule, that's usually when you get hit with a gap you can't close.
Precisely. That's when the math catches up with you.
So, our mission for this deep dive is to decode these anomalies. We're going to walk through the immediate March anomaly happening literally this week, then map out the rest of the calendar minefield for 2026 so you aren't blindsided this summer.
And we also need to have a very honest, perhaps slightly painful conversation about the math behind that 2.8% CLA increase everyone is talking about.
Yeah, we really need to strip away the headline numbers and look at the actual wallet numbers there.
Because understanding the schedule and the deductions is really your only defense right now.
Okay, let's unpack this. Let's start with the immediate situation. The report calls this the psychological trap of March 2026. Why is this specific week so dangerous for a household budget?
Well, it comes down to a foundational federal rule regarding supplemental security income, or SSI, and also for folks claiming benefits prior to 1997. The rule is actually quite strict.
How so?
If the first of the month falls on a weekend or a federal holiday, the administration cannot legally pay you on that day. They must move the payment to the nearest preceding business day.
Okay, so I'm looking at the calendar for 2026 right now. March 1st it's this coming Sunday.
Which triggers the rule. The payment that is earmarked for March, the money meant to cover your rent for March, your groceries, your prescriptions for the next 31 days, it is not arriving in March.
It's arriving this Friday.
Yes. Friday, February 27th, 2026.
So this Friday, millions of bank accounts are going to see a deposit hit. And here's where it gets really interesting, or I guess dangerous, depending on how you look at it. To the untrained eye, that looks like extra money in February.
Exactly. The analysts in the report refer to this as the wealth effect illusion.
The wealth effect.
Right. Imagine you open your banking app on Saturday morning, February 28th. You see your remaining February budget. Maybe it's just a few $100s plus this fresh full deposit.
So the balance looks artificially high.
Psychologically, your brain signals that you have a surplus. It feels like a bonus. It feels like breathing room to maybe grab that extra dinner out or buy a gift for a grandchild or finally fix that thing in the house you've been putting off.
But it's a mirage.
It is a massive, dangerous mirage. If you spend any part of that February 27th deposit as February money, you are walking right into what the report calls a hollow March.
A hollow March. That phrase really sticks with me. It paints a bleak picture of waiting for a check that isn't coming because it already came and went.
Think about the logistics of a hollow March. If you spend that money this weekend, you still have bills due on March 5th, March 10th, March 15th.
But the money meant for those bills is gone. It was spent on pizza or a new coat in February.
Exactly. The key takeaway from the source here is that the balance in your account on the morning of Saturday, February 28th is not your current spending money. It is your survival budget for the entire month of March.
It's almost like you have to play a mental trick on yourself. You have to hide the money from yourself.
You really do. You have to let the schedule dictate your behavior, not the account balance. The mantra the report suggests we adopt is know your schedule before you know your balance.
Know your schedule before you know your balance. That's incredibly smart. Now, if this were just a one-time quirk for March, maybe we could shrug it off. We'd say, okay, weird month, be careful.
But it's not a one-time quirk.
Right. As we dug into the full 2026 logistics report, it turns out this year is riddled with these shifts. It's basically a calendar minefield.
It is structurally difficult for budgeting all year long. The way the weekends and holidays align in 2026 creates this feast or famine cycle repeatedly. We just discussed March, but there are 3 other critical danger dates where this exact same psychological trap is going to spring shut.
I have the list from the source right here. Let's run through them, because forewarned is forearmed. The next big one is midsummer, right?
Yes. Look at August 2026. August 1st is a Saturday. So the payment for August actually arrives on Friday, July 31st.
So July becomes a double check month. You get your regular July payment at the start of the month and your August payment at the very end.
And you feel rich in July. It's summer. Maybe you want to take a trip, or you're running the AC a bit more, so your bill is higher.
But then you have to survive all of August, 31 long, hot days, without a fresh deposit until the very end of the month.
Which is a recipe for a very sweaty, stressful August.
Totally. Okay, then look at November. November 1st is a Sunday.
So the November payment moves back to Friday, October 30th.
October 30th, literally just in time for Halloween. But that money is meant for your Thanksgiving dinner.
Exactly. If you spend it on candy, costumes, or early Christmas shopping in October because you see a double balance, the turkey budget is gone. You're borrowing from your future self, but the timeline is so short you don't realize it until it's too late.
And then there's the big one to close out the year, the transition to 2027.
We are already looking that far ahead because it's a major disruption. January 1st, 2027 is New Year's Day, which is a federal holiday.
So the payment for January 2027 arrives on December 31st, 2026.
Right in the middle of holiday spending.
So let's synthesize this pattern for the listener. In 2026, we have 3 specific months, July, October, and December, where recipients will technically receive 2 checks in the same calendar month.
And subsequently, they face long droughts in August, November, and January. This affects annual budgeting deeply. The illusion of being flush with cash in those double check months is the single biggest risk to financial stability for fixed income households this year.
If you don't mentally ring-fence that early money, you just run out of road before the month ends.
You do. You hit a wall.
It really highlights how active you have to be. You can't just be passive with this system. And we've been talking a lot about SSI and those who get paid on the 1st or the 3rd. But there's a massive group of listeners, arguably the majority, who are on the standard retirement schedule.
Right, the post-1997 claimants.
Yeah, they're thinking, wait, I don't get paid on the 1st anyway. Does this affect me?
Well, for them, we need to decode the Wednesday lottery. This applies to regular Social Security retirement benefits for most people. The Social Security Administration essentially splits the population into chunks to avoid crashing the banking system with 70 million transfers on a single day.
So let's break down the groups, because confusion here leads to a lot of neighbor envy. I hear this all the time. Why did Bob get paid and I didn't? Did the government forget me?
Right, people panic. But it's almost never a mistake. It's just a schedule. Group 1 is what the report calls the veterans. These are people who started claiming benefits before May 1997, or people who received both SSI and Social Security.
And their schedule is different.
The rail is fixed on the 3rd of the month. If that's you, your schedule is consistent, you get paid on the 3rd. Unless it's a weekend, then it shifts to the Friday before.
But for everyone else, anyone who started claiming after May 1997, it's based entirely on your birthday. It has nothing to do with when you filed or what state you live in.
It's a staggered cycle. And it creates anxiety. You talk to your neighbor, they got paid, you didn't, and you assume there's a glitch in the system. It's usually just the birthday algorithm working as intended.
Let's run the 2026 dates for March, just so everyone can mark their calendars right now and stop refreshing their banking apps.
Sure. If your birthday falls between the 1st and the 10th of the month, doesn't matter which month you were born, just the day you were paid on the 2nd Wednesday. For this upcoming month, that is March 11th, 2026.
Okay. And if your birthday is in the middle of the month, the 11th through the 20th.
You are the 3rd Wednesday. That's March 18, 2026.
And the final group, birthdays from the 21st to the 31st.
You are the 4th Wednesday, which is March 25, 2026.
That is a huge spread. If you were born on the 25th of the month, you are waiting until nearly the end of March to get your March money. That feels long.
It is long, and that's why the practical application here is so important. Your payout date is a personalized cycle. It isn't a reflection of the system failing, it's the system sorting you.
You cannot compare your liquidity to someone born on the 5th of the month. You are basically living in a different financial time zone.
Exactly. You have to operate on your own time zone.
This brings us to the money itself. The schedule is one thing, knowing when it's coming. But the amount hitting the account is the other thing, knowing what is coming. And this year, 2026, we saw a cost of living adjustment, or CLA, of 2.8%.
2.8%.
And on paper, that sounds like an increase. Better than zero. I remember years where it was zero.
It is an increase technically, but the report demands we take a severe reality check on what that 2.8% actually does for a household budget. The source analysis breaks this down into nominal versus real dollars, and the difference is startling.
Let's look at the nominal numbers first. The average payment went from roughly $2,008 to $2,064. That is a gross increase of about $56 a month.
$56, that's the headline number. That's what you see in the news ticker.
Right.
But that is not what you can spend at the grocery store.
Right, because there is a leak in the bucket before it even reaches the beneficiary.
Medicare Part B. For most recipients, the premiums for Medicare are deducted automatically from the check before it's even sent out. And those premiums went up.
They always do.
The estimated deduction eats about $17 of that increase right off the top.
Okay, so doing the math, $56 minus $17.97.
You are left with a real net gain of only about $38.10 per month.
$38.
Mm-hmm.
In 2026 dollars, that's what? A tank of gas? Maybe?
Maybe half a tank if you drive a truck. A few cartons of eggs. It's not nothing, but it's certainly not life-changing.
No, definitely not.
And this connects to a structural flaw highlighted in the report regarding the CPIW index. This is the formula the government uses to decide that 2.8% number.
And the controversy which comes up every year but never seems to get fixed is that the CPIW tracks urban wage earners.
Right. Think about who that is. It's people who have jobs, people who commute, people who buy work boots, grab lunch at a deli, maybe buy new electronics. It does not track retirees.
Why does that distinction matter so much for the math?
Because the basket of goods is completely different. Retirees spend a disproportionate amount of their fixed income on two specific sectors, healthcare and heating.
Two sectors where inflation creates the most pain.
And two sectors where inflation consistently outpaces 2.8%. The source mentions a really striking stat. 77% of seniors feel a rise of less than 3% is insufficient.
Because their personal inflation rate is so much higher.
Exactly. Driven by meds and utilities, their personal inflation is much higher than the national average that tracks urban workers.
So you have a situation where the raise is $38, but the heating bill went up by $50. You're actually falling behind. You have more dollars in your pocket, technically, but less buying power.
Precisely. Which leads people to the logical conclusion, I can't cut expenses any further. I need to increase income. I need to go back to work.
And this brings us to the next trap detailed in the report, the working senior penalty. Because $38 isn't enough, many seniors are taking part-time jobs. Greeters, drivers, consultants.
But the system has a very strict leash on this.
It does. If you are under the full retirement age, which for most people looking at this now is 67, there is an earnings limit. For 2026, that limit is $24,480 a year.
$24,480. That's not a CEO salary. That's a very modest part-time gig. If you work 25 hours a week at a decent wage, you hit that pretty fast.
You do. And here is the punishment for hitting it. For every $2 you earn over that limit, the Social Security Administration withholds $1 of your benefits.
That sounds incredibly aggressive. The 1-for-2 rule, it's essentially a 50% tax on your benefits for working.
It is aggressive.
Yeah.
But the expert analysis points out that the danger isn't just the math, it's the timing. There's a massive misconception here.
What do people get wrong?
People think, it's fine, it's just withholding, I'll get it back later. And yes, technically, the SSA recalculates your benefit when you turn 67 to pay you back for those withheld months over time.
But that doesn't help you pay the rent today.
Exactly. That's the cash flow trap. The immediate impact is that your current checks stop coming. If you go over the limit in June, the checks might stop in July and August to make up the difference.
Wow.
You cannot pay your 2026 bills with money that is returned to you slowly starting in 2028.
It creates an immediate liquidity crisis. You're working to solve a cash flow problem, and by doing so, you trigger a rule that cuts off your main cash flow.
It's a classic case of The system's logic clashing with the individual's reality. The system says, you're earning money, so you don't need the benefit right now. The individual says, I'm earning money because the benefit wasn't enough in the first place.
It's a tough cycle to break. And then when people are in that vulnerable state, worried about the $38 raise, worried about the earnings limit, they start looking for hope.
Which brings us to the rumors.
Yes.
Yeah.
If you go on social media or look at certain news aggregators, you see headlines about a new stimulus check for seniors in 2026. Or a fourth stimulus.
Yeah. We need to be very, very clear about this. Myth-busting time, based on the facts in the report. Is there a stimulus check coming in March 2026?
No. As of March 2026, there is no federal stimulus approved. None. Zero.
So where is this coming from? Why are we seeing these headlines everywhere if they're completely false?
It's clickbait. Pure and simple. What these sites do is they take the standard 2.8% COLA increase, that $38 we just talked about, and they rebrand it.
They call it a stimulus to get views.
They call it a boost, a bonus, or a stimulus just to get you to click on the article.
That is incredibly predatory. It plays on people's desperation. You click hoping for $1,400 and you find out it's just the COLA you already got.
It is predatory. And it's
Right.
dangerous because it fosters what the report calls passive hope. If you were sitting there waiting for a magical government check to solve the budget gap, you aren't taking the hard steps you need to take right now.
You're waiting for a rescue that isn't coming.
Exactly. The advice is to ignore the noise. Focus on the knowns. The known is the $38 net increase. That is what you have to work with.
Strategy over hope.
Always. Strategy over hope.
Okay, so let's turn that strategy into a checklist. We've covered a lot of ground today. The March trap, the calendar dates, the CLA reality, the working penalty. If I'm a listener, what do I need to do right now before March begins?
The source material gives us a very specific action item list to regain control. First, log in to mysocialsecurity.gov.
Don't guess.
Right. Do not guess what your net amount is. Go see the exact number after the Medicare deduction. You need the real number to budget, not the gross number.
Knowledge is power. What's the second step?
Get a physical calendar. I know we all use phones, but seeing it visually helps for this. Mark the anomaly dates. Circle July 31st, October 30, and December 31st.
And write double payment on those days.
Exactly. Then go to the following months, August, November, January, and put a big red X on the first of those months.
Visualizing the drought before it happens. I like that. It stops the wealth effect from taking hold. And the third action item.
This is the most important one for this week. Ring fence the money. When that payment hits this Friday, February 27th, you have to physically or mentally separate it.
Move it to a savings account if you have to.
Yes. Do not let it sit in your main checking account where it can be accidentally swiped for a February expense. That money has to survive until the end of March.
It requires a lot of discipline.
It does. But remember the mantra we started with, know your schedule before you know your balance.
That's going to stick with me. Know your schedule before you know your balance.
Yeah.
Seems like the only way to navigate a year like 2026.
It really is. It's about taking control of the variables you can actually control.
This has been an eye-opening look at the mechanics of survival for millions of people. It's not just about the government sending a check. It's about the intricate dance of dates, rules, and hidden math.
Absolutely.
I want to leave you with a thought today. We've talked about how you have to fight your own intuition. The intuition that money in the bank means you can spend it, or that a raise actually covers inflation. If the system requires you to constantly fight against your own natural intuition just to keep the lights on,
Are you really managing a budget?
right? Are you managing a budget, or are you just navigating a bureaucracy designed for its own convenience, not yours? Something to think about. Thanks for taking this deep dive with us. Good luck with the March anomaly, and we'll see you next time.